Welcome to another episode of Don't Get Stuck in Your Business. Lessons in business growth and exit planning with your host, Joel Gubich, president of Big Picture Advisors and certified exit planning mentor. Learn the techniques and solutions to avoid getting stuck so you can build, protect, and extract your business wealth. Now, here's your host, Joel Gubich.
I learned the hard way as a novice entrepreneur in my first business that business revenue doesn't equal business cash. And I got stuck with account receivable issues. Now, if you're a business-to-business business, that is, you're selling mostly to other businesses, chances are at one point or the other, you've gotten stuck with receivables, especially if you extend credit. And even though we live in a period where almost everybody, including businesses, have their own credit cards, many businesses, both large and small, it goes across the board, get stuck with account receivable issues because quite frequently, they feel compelled to offer credit to their customers. Now, whether this is during a period of business growth and expansion or business decline and contraction, many of the causes and the solutions are similar. The important thing to note is that receivables represent an important asset to your business, and assets need to be utilized efficiently in order to be able to grow. In very simple terms, you as a business owner, when you provide credit to somebody else and create a receivable, you have provided that customer with the opportunity to use your product or service for free for a period of time until they actually pay you. Now, that's not a bad deal for your customer. Not a bad deal at all. You always like to get things for free, don't you? That magic word free. But it's a pretty bad deal for you because that means you don't have access to one of your assets. Somebody else gets to use your asset, essentially the cash that you should get paid for that product or service. This is a real double whammy because it can really hurt your business. You can get stuck in so many ways with account receivables. You get stuck with cash flow issues. Suddenly, you don't have the cash to pay your bills. You get stuck without the cash to fund your operations, whether it be salaries or paying your vendors. You get stuck without the cash to fuel future growth, product development, developing new products, new markets. And you get stuck wasting time and effort and financial resources just trying to collect what is legally and rightfully yours. How many people out there listening have gotten stuck wasting time trying to collect their account receivables? On today's episode, we're going to dig deeply into one way to leverage your account receivables to mitigate this sticky situation, and that's called factoring. Now, factoring isn't something new. It's been around for actually quite some time, but it essentially is the ability to borrow against your accounts receivable so that you have access to that cash and able to use that asset to your advantage until somebody actually pays your account receivable. You use a factoring agency essentially to go and collect the account receivable, and you borrow money from that factoring agency. And we're going to be talking today with Chris Plainness from Versant Funding about factoring. Chris has been providing financing to small businesses for over 20 years. And the last 4 years at Versant Funding, he's been responsible for over $130 million in factoring activities with businesses in a whole variety of industries. So I think we can learn a whole lot about factoring and how to be able to leverage that particular process in order to take advantage of your accounts receivable, make them work for you. So Chris, welcome to the conversation.
Oh, thanks, Joel, for having me. I appreciate it.
I recognize that many business owners are not familiar with the concept of factoring, and they certainly are familiar with accounts receivable, those companies especially that provide credit, that is, they sell their product or service for credit and expect to get paid later on for it.
Right.
But perhaps you can explain in really simple terms, and then we'll dig down a little bit deeper, what really is factoring and how does it work?
Sure. No, I think it's a great question because it's a commonly misunderstood program. But first and foremost, it's not a loan. We're not lending money to our clients. We are actually purchasing an asset from them. And basically how it works is when a B2B business completes a sale, whether that be for a product or a service, they invoice for that product or service and then send a copy of that invoice to us. We verify it, and by verify it, I mean we contact the customer that they provided the service or provided the product for and confirm that what the client tells us is accurate. And once we do that, we then advance our client 75% of the invoice amount. And now their customer makes payment to us. When we receive payment, we then give our client that remainder, that balance, that remaining 25%, less a fee. And the fee typically accrues at a rate of between 2.5% and 3% per month that the invoice was outstanding. And our clients use a factoring facility much like they would a line of credit, factoring more receivables when more cash is needed and less when there's less. But our clients don't qualify for bank financing. That's why they've opted to go down this route. So it allows a client the cash they can't get from other sources by using their accounts receivable.
Well, you mentioned one thing which in the prologue to our conversation I mentioned, and that is an accounts receivable is an asset. It shows up on your balance sheet as an asset, even though it may not show up on your balance sheet as cash. In fact, it shows up as an asset that you're owed cash because you haven't received cash. The minute that you receive cash, the account receivable goes away. And that's an important thing for any business to take advantage of their assets completely. And I think that's one of the things that factoring allows a business to do.
Very much so, and you make a good point there, in that it's something we see very often is for many of our clients, their largest asset is their accounts receivable, yet they somewhat neglect it. They don't have good data on what's in those receivables. They don't track them very well. They don't monitor them very well. But yes, it's a huge asset. It's an important asset and one that should be properly cared for by factoring as one way to leverage it and convert it into cash.
Well, you mentioned that part of your process is to be in direct contact with your clients' customers. And, I can imagine that probably would make some business owners a little bit nervous. They're my clients. I don't want some third party getting in touch with them. So how do you interact with those customers, and how do you put your client's mind at ease that you're not putting them in jeopardy, that you're not sort of stirring the pot in such a way that makes them look bad?
Yeah, honestly, Joel, that's a concern just about every one of our clients has when they approach us. And it's a valid one. You should worry what do your customers think of you, what's going to happen to your customers. But it's just never in reality a problem. For one reason is a factoring company is targeting businesses who sell to good quality companies. Those good quality companies typically are already paying factors for other of their suppliers. So this is just a non-issue. This is routine for them, where they're essentially flipping a switch in an accounts payable system, and now payments are going to a new address, a new company. We're not a collection agency, so we don't hound their customers for payment. If a payment comes in later or is coming in later than expected, our first call is to our client to find out what's going on. Maybe there's a dispute our client is working through with their customer, in which case they might ask us to just sort of sit back and wait for them to resolve it. Or maybe the client will tell us, this is a big problem, it's going to take a while to resolve. Let's buy back that invoice and we'll handle it, in which case that's fine with us as well. Or a client might tell us, what? We're never selling to this company again. They didn't tell us the truth. Collect from them and collect from them hard. But the point of all that is it's a collaborative process. We're not a collection agency. We're not going to do anything to damage our client's relationship with their customers. And in terms of the fact that their customers are going to know that they've entered into a factoring facility, it's much more routine than our clients understand. It's a very commonly used form of financing, and many of our clients' customers are already paying factors, and it's not the issue they expect it to be.
Does factory negate the need for a company to be aggressive in its accounts receivables collections?
Well, honestly, it depends how a company uses factoring. We have some clients where they factor every invoice they issue, in which case they've essentially outsourced all of their receivable management to us. We have other clients that are factoring only a single customer of their customer base. So in that case, they're responsible for all their other receivables, and we're just handling one of them. So the answer is it depends. We do have clients who essentially, they can just take their hands off the receivable process and entrust it to us, and others where it's collaborative, and then others still where we're only on the sidelines collecting a single of their customers' invoices.
So what type of businesses would factoring work for, and who would be a good candidate for a factor? I would figure that it's got to be a company that is growing, a company that's on its decline. Factoring could probably not something that's going to help them all that much.
Well, again, it's going to come down to what are the real issues that are impacting that company that's in decline. For one, it's got to be a B2B business. They need to be selling to other businesses so that they've got receivables. But we've got manufacturers, distributors, wholesalers, staffing companies, consultants. It really runs the gamut. In terms of where they are in their life cycle, we've seen some that are brand new. We've had customers where we factor the first invoice they ever issued to help them get started, get the momentum going. Other clients that you're right, are growing very rapidly, are on the upward swing, and they just need more cash than they can get from their bank. But we have had some clients as well that are just sort of in a rough patch. They're struggling, and their bank has either frozen their line or reduced their line or put restrictions on them that don't allow them to get enough cash. And our hope is to provide a bridge to keep that kind of company going until they are bankable. Now, there are some times where the issues that a business has, they're just too big for factoring to be able to help them for very long. But if the margins of the business are strong, whereby they make a lot of profit, gross profit, every time they make a sale, there's plenty of room in there to pay a factoring fee and bring more money to their bottom line. So if our financing allows them to do more business than they're doing before it, we can hopefully help them grow out of their issues.
Well, I think that's a important point, that a business has to look at its margins. I had a client a couple of years ago. I think it may have been the first time I think that we talked, and his margins just were not big enough. Yeah. When I did an analysis, his margins were like 25%, and there was no way that he was going to be able to afford the factoring and be able to grow his business. I mean, as it is, he was, even if he had traditional financing at the margin rate that he was at, it was going to be almost impossible for him to stay afloat.
We don't need to know a lot about a client's business to be able to help them, but one of the few questions we do ask is, well, what are your margins? Because if they're too thin, factoring isn't going to really work for you. It's just going to eat up too much of your profit, but it's a valid point.
One of the things that I talked about earlier is that when a company extends credit in a business-to-business fashion, essentially they're giving a discount. Because that's the way I look at it. Because instead of being able to get cash on the money, when they deliver a product or service and get paid for it immediately, what they're actually doing is giving somebody else the use of their money for a period of time. And who doesn't like to get something for free and use it for a while? So for all intents and purposes, it is a discount. And if you don't collect on it quickly, the larger the discount you're giving to somebody.
Very true. And what we've seen over the last couple of years is the economy has been very tight. A lot of these very large customers that our clients work with are stretching out their payment terms to take advantage of essentially that free financing that they're getting from their suppliers, which is just putting the squeeze more and more on the small to mid-sized businesses that we help.
So why, maybe this is a little bit off topic a little bit, but it's still within the same realm. Everybody's got credit cards these days, even business credit cards. Why, as a company doing B2B, why would you accept a situation where you're extending credit and somebody's not paying you, instead of saying, hey, you know what, I'll extend you 30 days credit, but after that I'm taking your credit card and you get billed automatically?
Well, what we see is a lot of our clients are a little bit afraid of their customers. They don't feel they have any leverage to take any kind of stand, to make any kind of demands. We have one that's fighting with their customer constantly, but fighting, by that I mean they politely ask every so often, hey, can you pay within 60 days, please? But our clients are there a little bit afraid. Sometimes for good reason. Some of our clients are selling a commodity, and if they make waves, their customer is going to tell them, I'll find another. But I see a lot of fear that our clients are afraid to rock the boat, and they'd rather get paid in 45 days than make a stink and maybe stop making sales. So that's what I see as fear.
I hope for those business owners that go down that path that they have built into their pricing structure enough margin to pay for that discount that they're giving somebody, perhaps even more, add an extra margin in order to pay for a factoring, in order to be able to have somebody else provide access to their capital or cash from their receivable so they can use it.
And my experience would be that the shrewder business people do, but lots don't. I was actually talking to a client yesterday who was thinking about factoring for the first time, and I didn't have to raise the subject to him. He was already thinking, okay, this will cost me about 5%. I can easily raise my prices by 5%, in which case this is a wash for me. So he was already thinking ahead as a way to use this financing, increase his sales, and have no real impact on his margin. But some clients either don't think of it, don't think they can get away with it, or are just afraid to do it, afraid to make a move.
And that's true. There's a sign of somebody being stuck in their business because they perhaps as positive, they don't believe in their product or their pricing or their service as much as they should, and therefore they sort of give up any leverage that they could to somebody else.
Very true.
What kind of information should a business owner expect to provide, in order to be able to start a factoring facility?
Well, it's honestly, we don't need to get all that much information to assess a client for factoring. Joel, my background, I could come from an SBA lending background. So I'm used to a credit application package that's measured in inches, multiple inches. A foot of paper was not unusual for an SBA loan application. But for factoring, I can get away with a few sheets of paper. I really need to understand the receivables of the business. So for me, if I get a recent account receivable aging, a list of the company's top customers with their addresses so that I can research their creditworthiness, and then a few quick questions about the business. We talked about margins. Tell me what your margins are. And tell me about any liens on the business. Because one thing we need to make sure we can get is a first lien on the company's accounts receivable. So if they have existing financing in place, that doesn't necessarily mean we can't help them, but it means there's one more step we need to get through. We need to collaborate with their existing lender to get that lender to release their lien on receivables, which we can sometimes do through a full payoff of the loan, or a partial payoff of the loan, or commonly through what we call an intercreditor agreement, where the bank, the lender, and the client agree on how the collateral is going to be handled and how the factoring proceeds are going to be handled. So we have a client where we've given the bank a partial pay down, and then every month, the first, I think it's $3,000 of proceeds to come through us are going to go directly to the bank. So the bank gets some comfort that, okay, I'm giving up some collateral, but I'm getting a payment every month from this third party to help me feel a bit more secure in going forward. So I took a little tangent there, but the point of that is I don't need to know a lot up front, just a few quick questions to figure out, is the deal viable, and then show me your receivable base.
The tip of the week for the episode titled Factoring, How to Leverage Your Accounts Receivable, is actually one of our business modules that you can download from our website, don'tgetstuckinyourbusiness.com, or from bigpictureadvisors.com. And this module is called Don't Get Stuck with Account Receivables. And in this module, we talk about and have worksheets and forms to help you actually manage your account receivables. Don't get stuck with it. We talk about factoring. We talk about all the issues that revolve around how to manage your account receivables. Again, don't get stuck in your business with account receivables, both on don'tgetstuckinyourbusiness.com and on bigpictureadvisors.com. So let's say I've got a company that I've got a fantastic opportunity. I know that I'm not going to be able to get traditional financing. I don't want to go and get outside investor. I don't want to dilute my ownership in any way. But I know that it would take longer for me to go the traditional route of going to a bank or something like that. But I don't want to say no to this. I want to be able to say yes to this great opportunity. So how long would a process take, let's say, through a factoring company in order to be able to be comfortable knowing that I can move forward?
Yeah, and that's one of the great advantages of factoring. Again, from my SBA background, things took weeks for credit decisions, months for closings. For me, when I get that list of information that I described, I can usually give a client some real solid feedback within 24 hours. If it's a deal we can do, we'll get them a proposal. Once they accept the proposal, we then get to work, and we can be ready to fund in about 3 days from that point. If there's a bank loan in place, might add a few days to the process, but essentially we can go from an introduction to a client to funding within a week. So that's a great advantage of factoring over working with a bank, and the bank just can't move that fast. So if speed is necessary, factoring can be a great option to take advantage of an opportunity like you described.
So what kind of businesses would you say would be the best candidates for working with factoring, and which ones would perhaps not work that well?
Well, the best are businesses, for one, with good profit margins and that have very strong customers. So for us, a very new company that sells to Walmart is a great fit. A well-established company with a great track record, but that sells to independent small businesses, that's not a fit for us. So what's important to us is, who does a client sell to? Who is their customer base? Also, one that's growing rapidly. That's a great choice for factoring, because banks, they have a tough time with movement, with motion. So a bank might approve a business today at a certain amount, but that business outgrows it. Well, it's going to be tough to reapply, to get an extension, get an increase to meet their needs. But a rapidly growing business is not an issue for us, because we don't approve a client for a certain amount. We'll factor as much as they can generate with creditworthy companies. So a business that comes to us at $100,000 a year, but they become a $5 million a year in revenue company a year later, that's a non-issue for us, as long as it's selling to big quality companies. So those are the best for us. companies growing rapidly, companies with good customers. On the flip side, I can't do anything for a retailer. So if they're not selling to other businesses, well, I can do absolutely nothing. Or if the customers are very small businesses, just not a fit, because all my focus is on the quality of that receivable. Who are they selling to? So those are where we can't be much help. And at Versant, anyway, there's a couple of industries we completely avoid because they're a little unusual, special laws around them, and those include medical practices and construction companies. So those couple of niches, there are companies there that focus on factoring nothing but those, and if anybody's interested, I can point in that direction. But we do just about any other industry with good margins, with good receivables.
Now, you mentioned before that, and I always looked at factoring as a bridge, essentially.
Mm-hmm.
And how does one get off a factoring situation? How does one grow out of factoring?
Well, what we usually see is that the client, for one, they get a strong enough track record, good enough financial history that they can pay us off with traditional financing. That's usually what's going to happen. It's very uncommon for a business to be able to just stop needing financing. And that's not usually what happens. They're usually paying us off with another source of funding. We've had some cases where a company's been acquired, so as part of the acquisition, we're paid off. We've had other cases where another factoring company has stepped in, so they're really just going from one spigot to the next. But usually we're being paid off by a bank, where the company has outgrown their issues, they're on more stable footing, and they can qualify for the type of financing banks have to offer.
What would be the minimum amount of time that it would make sense for a company like yours or any other factoring company to actually take somebody on as a client? I would figure that at least a half a year in order to sort of get things in motion.
Right. And there are some companies out there that will do what's called spot factoring, where they'll factor just a single invoice and there'll be no ongoing commitment. That sort of fills a special niche. That's not the niche we're in. For us, we're setting up a facility where we expect to factor for our clients on an ongoing basis. And as you point out, that takes some resources, that takes some time to get established. So we're typically looking for at least a year commitment. Our average transaction, we look for a 24-month commitment, but we have gone as short as 6 months if that makes the most sense for the client. But we are not, and most factors aren't in the business of doing really short term just because it just takes too long to get these things set up to not use them for a while.
How does a factor mitigate their risk? Because you're essentially assuming to some degree somebody else's risk of not getting paid.
You're absolutely right, and that's really what is happening. Our clients, by using a company like us, we're what's called a non-recourse factor. Don't really talk much about that. Non-recourse means when we buy a receivable, we take on all that credit risk. So you're right, that all the client's credit risk is now ours. So the first thing we do is we're careful about who we buy receivables from. We want to make sure that we have a very high likelihood that we're going to get paid. So I talked about we want to find out who the customers are right at the beginning, and we're going to research. We're going to do some research into who they are, what's their credit quality. So that's the first place, and that's the kind of information we give our clients, so that when they bring on new customers, we tell them what we think. And we might tell them, sell as much as you can. We might tell them, you might want to be careful and keep your credit to X. Or we might tell them, you know what, you might want to get COD from this customer because they're probably not going to be in business for long. So we're careful first about who we buy receivables due from. And then secondly, we verify. I mentioned that at the beginning. It's important that when a client sends us a piece of paper that says they're owed $10,000 from Walmart, that we really make sure that they're owed $10,000 by Walmart. In the factoring industry, one of the biggest risks, one of the most common things to take down a factoring company is fraud, where they were given a piece of paper, okay, let me fund it, and there was nothing behind that piece of paper. So for us, the most important ways to protect a factoring company is, one, be careful about the credits you buy from, and two, verify to make sure you're buying something that really exists.
Well, that's a good lesson before you extend credit to anybody. Even forget the factoring part of it.
And Joel,
how many people don't do that?
It's amazing. Yeah, we talked about how important receivables are to clients. It's amazing how few questions they ask when somebody wants to buy their stuff. Okay, somebody wants to buy 100,000 units of my product. Boom, you got it. Well, can they pay for it? We had a client just yesterday where they expect to sell $1 million a month of their product to what he told me was this real big hospital supply company. I'm like, wow, sounds great. Well, we researched who that hospital supply company was, and they're a really tiny little business with credit in the $80,000 to $100,000 level. So our client was asking no questions, prepared to sell $1 million of product into this company that has a very low likelihood of being able to pay for it. But it's so common. You probably know this as well, where a lot of small business owners, they're salespeople at heart. They want to sell. They believe in their product, they believe in their service, they want people to buy it. Well, can they pay? That's secondary. We'll figure that out later. But we bring that reality to our clients. we ask them, tell us who you want to sell to when you bring on a new customer, and we'll tell you what we think of them. But a lot of customers, they don't want to go there. They just think about getting paid for the sale secondarily.
That's true. Well, the dollar signs are great, but it's really what's in your pocket that really
Absolutely.
counts.
Absolutely.
I remember from one of my previous businesses, one of the things that I used to do, it's actually a good tip for anybody who's actually doing B2B credit, make sure that you've got a good credit sheet that you ask people to fill out. But what happened is that most people were giving me credit of their best customers. Well, of course, they're not going to give me the credit history of a company that they may not have paid to on time.
Mm-hmm.
So I'm not interested in your best customers. I'm interested in your real customers. So what I would do was I had a list of companies that I knew that most people would buy from in my industry. And I said, well, do you have a credit history with this company? So, because that was something I could get on the phone with the CEO or the president and said, hey, could you share any information, non-confidential? So instead of somebody giving me their almost made up credit report, I got real information. And that's something that I guess you guys end up doing once you take on a receivable to factor it. You dig down and find out the real information about that company.
Right, and there's many a deal we pass on when we can't get the information. It's not uncommon that our client, for one, is afraid to ask for information. Most commonly, what puts us off is, like this deal I just mentioned, the hospital deal. Our client does not want to ask the question of, can you send me information, financial information? So that's often the reason that where a deal just dies, where they don't want to tell me, they don't want to ask. We can agree to look at our client's customers' financials completely confidentially. We'll sign a non-disclosure agreement, but again, most often our clients just don't want to even ask.
So what is the true cost of factoring? I know that as a receivable takes longer to get paid, or for you to receive the money from that receivable, the cost to the client goes up. And well, it should, because you're assuming a larger and larger risk as it takes longer to be able to receive on it. So, So could you break down what the typical cost factors, how they break down in a receivable?
Sure. For one, I can tell you that the way Versant prices their deals is maybe different from a lot of other factoring companies. We try to keep it very simple. There are some factoring companies that will have multiple types of fees, like there'll be a fee for each invoice, there'll be a monthly fee for the facility, there'll be a interest rate on money advanced, so it can be more complicated to determine what is this actually costing me as a business owner. We try to keep it simple, and our typical factoring fee is 2.5% of the invoice amount for every 30 days an invoice was outstanding. And more specifically, that 2.5% is for the first 30 days, and then every 10 days thereafter, the fee goes up by 0.84%, or a third of the 2.5%. So our average client gets paid in about 45 days, so their discount is about 3 to 4% of the invoice amount in total. So the way the funds would flow is our client would get 75% up front, and then 40 days or so later, they would get 21%, with the 4% being a fee to Versant. So if the profit margins were strong, which we like to see 30% or more, well, net profit margins really have gone down by that 4% fee. But if we can help them complete more sales than they were completing before, okay, now their margins have gone from 30% to 26%, but they're still dropping more money to the bottom line with each additional sale that we help them to consummate.
Which goes back to one of the things that we talked about early on. Your account receivable is an asset, and that asset, if you don't utilize it correctly, is wasted.
True.
And factoring is one of those mechanisms where you can take advantage of your account receivable asset so that you can not only maintain your company, you can grow it. And if you don't take advantage of your account receivables, if you let it hang out there, then you really are throwing money away at some point.
No, it's very true, and it's not uncommon for our clients to balk at the cost at the beginning of the process, particularly somebody who's become accustomed to bank lending. And sure, if you can get a bank loan at prime plus a couple of points, by all means, you do that. But our clients don't qualify for that. So for our clients, their options are, well, for one, forego business, so stop taking on those new sales, and don't drop that 26% to the bottom line, or take on a partner. And that can bring on a whole new set of challenges. Now you're giving away equity. Now you're giving away a portion of your profits. You're bringing in another decision maker, possibly someone who's going to meddle with the way you operate. We're temporary. It's easy to get rid of us when you're done with us. A partner, not so easy. So if you can qualify for all the financing you need from a bank, right, doing what we offer doesn't make a lot of sense if you've got time to wait for a bank to make a decision. But if you don't have the time, you can't get the credit from other sources, and you've got the margins, that's when our financing can make a lot of sense.
It's been really an informative discussion on these issues of factoring and accounts receivable funding, how to really leverage that accounts receivable. And for the listening audience, go to our show notes page on don'tgetstuckinyourbusiness.com. We've got links and worksheets and other resources regarding factoring and all the issues regarding accounts receivable. Don't get stuck in your business with accounts receivable. It's an asset. Make it work for you. So thank you, Chris, for coming on the program.
And thank you, Joel, for having me. It was great.
You've been listening to another episode of Don't Get Stuck in Your Business, produced and distributed by Big Picture Advisors. To download this and other episodes, as well as to access the program notes, visit don'tgetstuckinyourbusiness.com. Subscribe and download this and other podcast episodes on iTunes and the Stitcher Smart Radio app. This podcast is offered with suggestions and ideas on business, financial, and exit planning. Contact a certified financial